Hey, it's Justin Harvey. Thanks for tuning in to the Anesthesia and Pain Management Success podcast. With APM Success, we take a close look at important topics pertaining to business, practice management, personal finance, and careers for anesthesiologists and pain management physicians. We work hard to take your critical questions straight to the experts. Thanks for listening. This week I'm speaking again with my friends, Stuart Neiberg and Daniel Kvarnberg, about private equity consolidation, this time in the context of pain management practices. This is going to continue to be a recurring theme on this show as private equity has a more and more pronounced presence in healthcare. And what we want is for physicians to be empowered and equipped to understand what are these dynamics, what does it mean for practice, what does it mean for physician exit from practice, what does it mean for employment, all that stuff. We tackle all that and more in this week's episode. As always, thanks for tuning in. Hello and welcome to episode 77 of the Anesthesia and Pain Management Success podcast. As promised, I'm bringing to you this week part 2, the pain management sequel, to our conversation around private equity, industry consolidation, and the like. I'm here with Stuart Neiberg and Daniel Kvarnberg of Physician Advisory Solutions, here to lend their expertise on consolidation in pain management. Gentlemen, thanks for joining us today.
Yeah, thank you very much for having us back again. Just a quick overview about Physician Advisory Solutions. We are an advisory and full service valuation firm. Our goal really is to help physicians become more efficient, more profitable, and increase their overall value for the best possible exit for a liquidity event. We also, the way that we accomplish these goals is really by looking at financials, operations, business strategic initiatives. On the valuation side, we provide all aspects of valuations from partnership buy-ins, valuations for transactions, and compensation, fair market value valuations, all aspects of the valuation world. Our clients really are nationwide, and they are anywhere from single physician practices all the way up to large healthcare systems. Along with me, my partner, Stuart Neiberg, he is a CPA ABV, which he's accredited in business valuation. He's also a CFA and has been involved in over 1,000 healthcare transaction evaluations.
You're a CPA and a CFA, and I didn't know that until now.
I am. Yeah, that's correct. A lot of time studying.
So we're fellow financial people, and I didn't even realize it. Well, thank you very much for joining us today. I want to talk about the involvement of private equity in medicine and specifically in pain practices. And we talked last time about anesthesia and the role of private equity there. But I think in the interventional pain space, there's a little more meat on the bone, and I'm looking forward to unpacking this. Maybe to start us off, Stuart, just give us a little bit of context for what are you seeing right now, or what are some recent transactions you've been involved with having to do with PE in pain medicine?
Yeah, no. Good questions, Justin. And yeah, there definitely is a little bit more meat when you start getting into the pain management subset of this specialty. And when I say meat, there's a little bit more creativity with regard to transaction structure, usually with ancillary forms of income. Physicians' ability to generate excess profit margins, through different means. And then when private equity comes in, they obviously want to take a look at different aspects of a particular practice, multiple locations, how are you leveraging, other, mid-level providers? Is there a surgery center component? Is there, a physical therapy component? Is there potentially a DME component or a pharmacy component that, many of these physicians who are generally a bit more entrepreneurial try to take advantage of. And, the more ancillary revenue and profit that could fall off the bottom line of one of these businesses could drive substantial value and could drive, more scale and a larger multiple, when you're looking at a financial buyer, such as a private equity fund.
Yeah, so Daniel in his intro used the word valuation a few times, and you just mentioned this word multiple. So I want to talk about this because by and large, our audience is non-financially oriented, trying to get this information, but don't necessarily know what that means. So when we're talking about multiple, maybe just give us a very basic explanation of what are we talking about when we say a multiple that something is transacting at, and give us a couple different examples of what a business, specifically, what a pain practice might look like and what that might mean in terms of multiple.
So generally in the healthcare world, a multiple would be, a multiplier on top of the profit stream of a business. So if someone were to buy your business, they would say, all right, let's say you have $1 million of earnings. Hypothetically speaking, if you had a multiplier of 5 times your earnings, the purchase price of your business would be $5 million. Now, when we break it more into the financial definition of a multiple, it's essentially calculating the inverse of what the growth potential of your business is, less the risk associated with your business. So if you have more growth potential, all things being equal, you would have a larger multiple. If you have more risk associated with your business, you would have less of a multiple associated with it. So multiples are used quite frequently because it's a common nomenclature in the financial buyer and even the strategic buyer world. But when someone says to you, here's your multiple, for a physician to really understand it, the higher the multiple, they really are saying that there's more growth potential compared to the risk in your business. And the lower the multiple, they feel there's less growth potential and more risk associated with your business. So I think that's always an important distinction, to initially talk about with someone, is that, there aren't just arbitrary multiples out there. It's really some sort of calculation associated with growth and risk opportunities with a practice.
And are there any rules of thumb as far as multiples for different types of practice or different sizes of practice?
Oh, yeah. I mean, like generally, very, very small practices, they may not even get a multiple. Someone may say, well, I think your practice is worth generally, the equipment, and, maybe I'll give you a couple dollars for your medical records as well. As practices scale and have multiple physicians, multiple revenue streams, some of the smaller practices that have, like I said, more growth potential because they've diversified the physician base, they diversified the patient base, and there's more growth compared to the risk associated with, let's say, a one doc practice. You can generally command, like 5 or 6 times earnings multiples for some of these smaller practices that have demonstrated scale. But then, we start looking at, some of these more massive transactions with hundreds of physicians associated with it. That private equity comes in and drops hundreds of millions or billions of dollars even. I think Ares Capital Management dropped like 1.5 billion on a multi-specialty practice about 2 years ago. Those practices, that have substantial growth opportunity because they will attract new recruits and have, limited their downside risk because there's diversification over physicians and services. Those practices could sell for 10, 12, 13 times earnings at the end of the day. Very substantial multiples in this world.
And so there's actually some overlap between my industry of financial planning and financial advice and this solo practitioner situation where the more infrastructure you build around a doctor, the more you can sort of plug in any random person, and I'll put that in air quotes, any random physician to come in and run the system that you've put in place, the more valuable an entity is. So if I'm a doctor and it's just me, to your point, Stuart, about the solo practitioner, like if I get hit by a bus tomorrow, God forbid, my practice is only worth the value of the C-arm and like whatever's left on the lease. Whereas if I have a system in place and I have a couple other, providers who they can, there's a really good operations manual and I can plug in new employees there. That's what's going to give value, because then I can remove myself as the founder or as other employees. We can create that value because of the system and because of the way that it's not contingent on the value of the person who's running it. Is that fair to say?
Oh, absolutely fair to say. I mean, you would definitely want to take into consideration that scale opportunity. And that's sort of how, to get back to our initial, topic of conversation, is the private equity interest in these practices. A lot of them use this hub and spoke model where they're going to want to buy, not a huge practice, but a substantial practice that, can serve as sort of the base operations or serve as the hub in this particular fact pattern, and then add on to it. Because private equity wants to create more scale, more diversification, more opportunity to have this plug and play system in place. And the larger they are able to get that point too, with add-on acquisitions and recruiting new doctors to their particular platform, they get to then exit at a much more substantial multiple than they buy in, because that's the goal of private equity, is to buy a business and then make it I'm not going to say better. I will say make it different, but will in turn, generate a larger return for their investors themselves.
So to kind of put a tangible example, they might buy a smaller practice with a couple doctors, and it's a low multiple because there's not a lot. There's still business risk because the founders, the partners are very involved, and if any one of them left, it would be a cataclysmic event for this small practice. But if they buy it for 1.5 times profit, and then they build this infrastructure around it, because a private equity company, that's what they're good at, is like business strategy. How do we systematize? How do we make efficient? And again, this, you could argue whether this is good or bad. There's certainly major challenges and problems with that. But if they do that, they insulate this practice from some of this business risk. And then the multiple grows. If they buy it at 1.5, then they can sell that same practice at 6. And hopefully the profits have gone up in that time.
Exactly.
And that's where they make their money.
Yeah, that's the big thing. Is it's sort of a two-pronged approach on the private equity side, Justin, is not only, they buy this smaller practice, let's say there's a couple 100,000 of profits in it, and they get it for a lower multiple, but it's almost, I don't want to say an arbitrage, but it's like an arbitrage pay where they, they increase not only the multiple, but they increase the profits on it as well. So there's sort of a double whammy in terms of their returns.
Yeah. And so it's important to point out, for physicians who are thinking, we've gotten about 13 minutes into this episode and haven't said anything about patient yet, or patient care. Yeah, you're right. And that's one of the challenges, is that if you're looking at a medical practice like it's a balance sheet or an income statement, that's the problem, right? And that's one of the challenges with medicine. And so my hope is that as we work through this topic together, physician listeners are going to be able to be more equipped, more informed to enter into this conversation as stakeholders with a seat at the table rather than being on the menu.
Exactly. And I mean, that's the thing at the end of the day, is that physicians need to realize what their importance is in this particular function. They're the ones that are delivering the care. And I don't want to say that we're in a world of commoditized medicine, because I think that there is some unique aspects that every physician can bring to their particular patients. And, they should be paid rightfully so for that at the end of the day.
Yeah. So talk a little bit about, I want to take, maybe we can do like a mini case study on the fly here. And for a practice that comes to you and says, Stuart, I'm interested in an infusion of capital. I want to take on an outside investor. I want to expand. I want to take this really great model that I've built. I want to have some smart people who can help me make the model better. And then I want to be a part of opening a couple other locations and, grow the practice, grow the things that we're doing here as part of Pain Practice ABC. And I want to make sure I'm getting the best deal that I can in this transaction when I'm bringing in an investor to, have this liquidity event for myself, because I'm trying to retire someday. As somebody who's coming to you with those types of questions, how does that conversation go? What are you asking them? What kinds of things should they be thinking about if they're interested in outside investment with private equity?
Yeah, and I think the first thing that we have to do is we have to unpack the particular practice that we're looking at right now. Is this, two docs working together in, one or two office settings? Is it a situation where, we have a surgery center component where, we're kind of, playing the game, do we move cases to the surgery center versus an in-office setting to maximize profitability? As you mentioned, Justin, what other ancillaries are there in there? Do they have a C-arm? Are they exploring imaging opportunities? Is there a pharmacy? Is there PT? So, it's really about, seizing all different profit streams that make the most sense from an ecosystem of delivering care to their particular patients. And then seeing whether or not it makes sense to, potentially drop one of those and then do a deal, add one of those and then do a deal. What is the use of capital? Are we just going to use the capital to, buy a home in the Bahamas and, not practice medicine ever again? Are we considering, staying on for a period of time to transition the practice to someone else? Is the goal going to be that not only do we have to stay on, but we have to recruit 3 or 4 new docs to grow the practice as well? And are we using the capital for that? So, it's really, I guess when you meet with a client and you put together, the investment opportunity and, the plan and, you assess what their risk tolerance is and, where they want to be and what, short-term and long-term expenses they're going to have. We also want to do the same thing, with a physician that's exploring a transaction. Where are you now? What do you have to plan for in the future? What do you want to plan for in the future? And, how can we get there reasonably, with the amount of capital that could come into the business, that could be expected because, sometimes we do have to have those very difficult conversations that, there could be one or two docs that say, oh, hey, I read about this practice that, sold for 12 times earnings, can you get me 12 times earnings? And I have to say, well, hey guys, like, guys and ladies, like, I don't think that that's going to be a feasible option right now, but if we want to get to that point, here's the playbook to how to get there. And, that's where you want to be.
And you said something that I want to come back to in a minute, but it's interesting. When we're talking about these multiple expansion and buying at a certain multiple, I'm reminded of this thing we have in finance called the greater fool theory, which Stuart is obviously familiar with. So the idea that eventually you're buying something that's so expensive that it's untethered from the actual value of the thing, and you're counting on somebody who's a greater fool than you to come along and buy it later. And any listeners, you can Google the Dutch tulip bulb craze, which was like the original first time that this idea was codified, where in the 1500s, tulip bulbs, tulip, like a flower, were being sold and traded, and then there was a frenzy, a buying frenzy, and they got very, very, very valuable, but at the end of the day, it was still like a little thing that you plant in the ground that grows a flower. So people were transacting on tulip bulbs with the idea that a greater fool would come along later, and the tulip bulb that they bought for $7,000, they could sell to somebody else for $9,000. And so as you're thinking about multiple expansion and like 1 times, 3 times, 5 times earnings, the point is the more expensive you're buying something, the harder it is to add value, and the more you're dependent on somebody else who's going to view this situation perhaps with rose-colored glasses in order to pay you even more than what you paid for it. So that's an important dynamic to keep in mind here. Stuart, you mentioned the idea of the surgery center and the integration of a surgery center into if you've got a couple offices in a surgery center. Talk a little bit about why does it matter where a patient has a procedure done? How does that work as far as the site of service differential? Maybe you can take a minute and unpack. And do you frequently see, or maybe give us a couple examples of, have you worked with physicians who they were doing it all wrong? They didn't realize that they weren't taking advantage of the surgery center the way that they needed to, and as such, maybe weren't as profitable as they could have been?
Oh yeah, no. So, I mean, obviously, Justin, that's a great point. So every year, CMS puts out, what the reimbursement is for, different procedures. And, over time, as we've tried to move patients away from an inpatient hospital setting to limit, healthcare costs, they've allowed more surgeries and procedures to be done in a surgery center. So, day in, day out type of thing. Even more so lately, the same procedures that have moved to a surgery center have now moved to an in-office setting. So that way, if you have a physician practice, you can do a lot of work that was once only allowed in a surgery center in an office. And frankly, you get a different reimbursement amount if you do it in an office versus if you do it in a surgery center. And that largely stems from the fact that if you do the same procedure in an office versus a surgery center, you typically will have less expenses associated with it. There's many more regulatory restrictions associated with an outpatient surgical facility that are just going to drive the costs of surgery up there. However, especially in pain management and what I've seen, and I would say most of the physicians that I've worked with in pain management, they haven't been doing it wrong, but they've almost been doing it too well, where they have really mastered the art of getting the right billing and collections person. And they enable you to, say, all right, well, these particular commercial insurers, we're going to do them all in the surgery center. But any Medicare patient, we're going to do it in the office. And it could be vice versa in different geographic locations as well. But they've been very good about putting the right payer for the right procedure in the right facility in order to maximize those profits. And I've seen a lot of pain management docs do very well in that regard. And it's a very powerful tool to use when you integrate the surgery center and the in-office setting into the overall personal financial picture.
It's also mind-numbing when you realize doing an injection in a hospital outpatient department is going to cost, from an insurance standpoint, like 3 or 4 or 5 times as much as if it was done in the office, when it's the same needle, the same drug. It's a good example, I think, of how messed up healthcare is personally. And also of the power of the hospital lobby. Like, if hospitals are getting 5x for that same procedure, there's a reason for that.
Exactly. I mean, like, I can tell you that there was once a situation, not to divert from pain, but I was working with some GI docs, and if you did a colonoscopy in their ASC, it was 5 times the reimbursement as if you did a colonoscopy in an ASC about 10 miles down the road. The exact same procedure, but they were getting 5 times the reimbursement for it.
Because of the contract that they had with the payer, you mean?
Exactly. They're partners, the contract with the payers. So, it's amazing what's going on in the world and how some people are able to take advantage of it. And hey, look, we're in a capitalistic society, so it makes sense. You can take advantage of it, but it's remarkable the kind of variation in these things.
Yeah, and so I got to take it in like bite sizes, because if I look at the whole, it's just so overwhelming, And I try to like say, okay, anesthesia, pain management, this is my little corner of the world, and it's complicated enough trying to understand, this stuff as it relates to one specialty. I'm curious what you think about the idea of solo practice. I'm a big proponent of and believer in independent physician practice, just because of the autonomy that it gives a doctor to make their own decisions clinically, business-wise, and all that. Obviously, there's a lot of the forces of healthcare are not super friendly to independent physician practice. How do you perceive the outlook for either a solo practitioner or an independent practice in light of the current environment with PE and with consolidation and with big money and big medicine and trying to, play with the big boys out there?
Yeah, it really it becomes, what does the physician's preference? Do they want to, have the autonomy of being a sole practitioner? And just because, if someone wants to be a sole practitioner doesn't mean, they can't create their own little empire. You can bring in, certain ancillaries, you can bring in other employed docs who, might just want to collect the paycheck and not run a business. So, if you want to be entrepreneurial and you want to try to maximize your earnings, there's pain docs that are very successful and can put that kind of thing together. Look at just, starting a business in America, with regard to whether you want to be a solo pain doc or whether you want to open a furniture store, it's tougher now. I remember, you could hear all these stories about people from the 50s and 60s that went and got a $15,000 bank loan, and then they were able to start these massive operations. I mean, it's just, everything's tougher. Everything's a little bit more expensive right now. So it's whether you want to do that or whether you want to, get a really nice salary, go work for, one of these public companies or a private equity backed, substantial group. You're going to get your pay on the 15th and the 30th. You'll get a great bonus structure. They will do all the marketing. They will do all the admin. They will take care of all your billing and collecting. It really just depends on, whether you want to take that entrepreneurial step forward or if you want to be an employee, which I respect both at the end of the day.
Well, and to add on to that, it's a great exit strategy too, to go private equity. If you have that entrepreneurial way of thinking, to then as you're getting older, where you're getting sick of managing everything, you can exit, still work, have the nice cush job, good income, everything like that. But it gives you that liquidity event and those options. So, I always think it's a great way to look at it for your exit strategy down the road. You don't want to wait till, 6 months before you are going to exit, say, all right, I'm going to sell my company, and then not work again. That really lowers your value. But if you are saying, all right, well, you know what, I want to stop working in 3 to 5 years, that's a good time to exit to, say, private equity or joining a larger group, because then you can slowly phase your your workload out and, actually have a really nice sized liquidity event, which then, is better for you to help them manage that money.
Yeah, that's a good point, Daniel. And also, if you give yourself that runway, I mean, you could make an argument at the very beginning, day one, you should be building infrastructure in your business that is creating, automation value, that it can run without you as much as possible, creating those policies and procedures and the business intelligence to allow that to happen, so that when you do exit, it's a little bit, you're going to get a higher multiple because it's a better functioning business. It's more profitable. Employees know what to do when they show up. Patient care is very consistent. You get good outcomes, and that's going to be a more enticing deal for somebody coming in with some cash that's looking to make an acquisition like that. Maybe, Stuart, can you just take us through a couple recent deals that you've either looked at or been involved with, and just talk about what happened. What did you look at? What did you find? And how did it all work out?
Yeah, no, recently just was involved with a fairly large transaction, very, very successful pain management physician, who, had done and I think this was just, right at the beginning of COVID, had about 14 locations, multiple surgery centers, several ancillaries, did a very good job moving cases back and forth between, the surgery center versus the in-office setting. Many employed physicians, was able to retain, a good group. I think all in all, there was about 8 doctors, and several ancillary opportunities. I'd worked with them for many years. I had helped with, a couple of the front end aspects of the transaction and a couple of the back end aspects to, assist with some tax purposes. But, just
So when you say front end, are you talking about like the actual deal to sell the practice?
Yeah, the M&A due diligence on the front end, exactly. And then there were some, stuff on the back end I assisted with a personal goodwill allocation and, minimizing tax burden and whatnot. So we could, handle all of that type of work. But, they were essentially, with the size of their practice, they were essentially becoming the hub. And now this financial buyer was looking to add on with spokes all over the country. So this was a situation where, it was a very well-established, well-diversified business, had all the, checked all the right boxes, had been preparing for the transaction, I would say probably about 3 years, and setting themselves up, to have all of the right systems in place, the right legal structure, right ancillary revenue streams, and just was overall a very impressive operation. It was a very charismatic senior physician that was involved, who could talk their way through the deal as well. So, for me, it was an easy transaction because, all the pieces were, right where they should be. So, as of most recent, I'd say and they got it done in the midst of COVID. So, that's the other thing that's impressive too, is that they were able to close that deal.
When someone like that comes to you, do you have, private equity buyers that are kind of on your list, or like, oh, I know you'd be a good fit for ABC fund, let me get them on or how does that matchmaking process work?
So this one, it was sort of a newly established financial group that raised a little capital. So they came to me already with a buyer in place. And we were just sort of helping out on sort of an advisory standpoint. Yeah, I mean, look, practices, with private equity, we can make a dozen phone calls and, we'll get a handful of people that are very interested. And, depending on the specialty, pain management, very hot, very specific attributes to a practice that they'll look for. If you want to be that hub position, and get sort of the larger multiple up front on a liquidity event, you got to fit the bill. You got to have, multiple doctors, diversification of risk. If you want to be an add-on, look, 2 docs that have a couple locations and an ASC, that's the perfect add-on right now. And, I think that, people that would be interested in that type of model, there's different people that we call for them versus if there was a 12 doc physician practice that wanted to put a big deal together.
What do you mean when you say add-on?
Oh, so like you buy so think of it like a hub and spoke model. Just so you have a large practice that you put together. They get a financial buyer to come in and give them a bunch of capital. So now they don't want to keep that practice the same size for forever. They want to add on, 2, 3, 4 docs, at a time. And if possible, they can do an M&A deal with a much larger group as well. They'll explore that also. The capital for these kinds of things, is abundant. I actually had a conversation with an investment banker that, exclusively does healthcare, and, really, loves the practice acquisition world right now. And, he basically when he said to me, send me some practices, the bigger, the better, the bigger, the better. Everyone will make a whole lot more money. The bigger, the better.
Talk a little bit about the hub and spoke idea, how that works in practice. So I understand, like, you buy a hub and then you try to, I guess, find the spokes. How does that work? Like boots on the ground, who's who's doing that actual implementation? Is it something where the private equity says like, we're going to buy this practice, and then the private equity company with their executives or their like whatever their deal team's going to go in and they're going to like try to find other practices that could be another acquisition target, or are they launching new practices, or how does that work?
So it's a combination of a few different things. They want to have that practice. First, they want to get the base practice that they bought situated. They want to get the right systems in place, the right people in place. Usually there's some sort of management company that's going to come in and oversee it, because the word is scale. They got to be able to scale this thing. Then it's a combination of, a few different strategies. One, recruiting efforts. Work, because of the cheapest way that they're going to find new docs is just by recruiting new docs to just take a job, so that pay them a good salary. That's great. Then there's the add-on acquisition, 2-doc practice, 3-doc practice here or there. Maybe they have an ASC also. That purchase price is going to be a lot more reasonable from a multiple standpoint than if they were to buy a 25-doc practice, realistically. So, they can probably get some debt financing to go out and buy these practices and roll them up, and once those practices are no longer duplicating efforts in terms of, back office management and billing functions, there's scale, and you can grow this thing to something even larger. Now, the third thing, which is the most costly, but, if there are synergistic impacts to it, is, do we find another 20-doc, 30-doc practice to roll into the business and do, real M&A at this point? And, if the financials and, the operations yield that to be a good opportunity, then, 100% they'll explore M&A, and then from that point on, after the practice is scaled in place, how do we get to a point where, we can exit for a multiple that, is going to be much larger than what we originally paid?
Okay, so two things that are come to mind. The first is, I'm curious if I'm a physician, I'm, me and my buddies are 100% equity owners in this, practice and maybe a surgery center, and we want to sell a piece. I'm curious how popular this is to maybe a private equity company wants doctors that are invested, that are going to be committed to growth. And one of the ways to do that is to have a fractional sale, right? It's not private equity buys 100%, private equity maybe buys 50%. So if I own like a 30% stake of a practice, I might sell half to the private equity company at a low multiple of like whatever, 2 or 3 or whatever we're kind of worth at that point, with the hopes that my remaining 15%, if I am good at, I stick around, I'm recruiting doctors, I'm trying to launch new practices, I'm doing all these other things, that 15% that I kept, maybe I can sell down the road for 5 or 7 or 10x. Is that a pretty common structure to this type of, sequence of events or these types of deals?
Oh yeah, no, I mean, private equity is going to want to try to keep the physicians engaged one way or another. And I think that, you can get creative, especially in states where there's corporate practices of medicine laws, where you establish like a management services organization entity on top of the physician practice. And then you can have non-physician owners involved, as well, and then give the physician owners and, create some sort of joint venture structure. So, there's definitely a way to do that to keep the physicians engaged in the business. A lot of times, when health systems do these deals, they just buy the whole thing outright. There's no joint venture with the docs, that they buy it outright and the docs become employees. So, but I think there's a couple different mindsets. Can you make the docs whole with subsequent bonuses and, other types of, revenue streams that they can monetize personally, so that they don't need to have an ownership stake in the practice. Or, do you run the risk of the docs, doing a deal and then leaving? So, you want to keep them, involved in the equity some way whatsoever. So I think I answered a lot of the questions last time, Justin, with, it depends. And I think this is sort of an it depends situation, just on the temperament of the physicians and the partnership and whatnot, and, whether the deal makes sense one way or another.
Yeah. I always try to look at things through the lens of someone who's trying to build their career, trying to grow and build wealth and come into a place where they can invest themselves and be rewarded for that investment. And so I'm curious in your perspective, looking through that lens, as you look at what private equity is and means, and if a practice just sold for an 11x multiple down the street, and you understand what that means, like somebody bought this and paid a lot of money for it, and they're sort of banking on being able to take that from 11 to 13. and what that means from a business operations standpoint. What does that mean for me as a physician? Or does it mean anything? I mean, I look at that and I think, oh gosh, like there's going to be capped upside. I'm not going to have as much flexibility. There's not going to be like as much of a likelihood that I can do a surgery center or something like that. It's just there's no partnership for sure. You know, what should I interpret about that kind of situation, or am I totally off base?
No, I mean, I think it's good. I mean, I don't think it, I think it'll impact you as much as you want to let it impact you at the end of the day. I mean, I think what does that mean that physician practices are selling for 11, 12, 13 times earnings? I'll be completely honest with you. I think it just means that certain private equity funds just have way too much money right now. I mean, that's just that's what it is. I mean, people have been really good at raising capital, and we have to deploy the capital somewhere, and we're going to pay a substantial amount for it. Because at the end of the day, the physicians are meant to be driving care to the patient population. That's the goal of what they should be. Now, some physicians have been incredibly entrepreneurial and have developed, very substantial ancillary revenue streams and built, massive operations. But the main goal at the end of the day is driving clinical care. And I think that, the thing with the physician practices, for private equity, there's so much continuity. People will always need healthcare. So it's a safe bet to deploy capital into these operations. But at the same time, because there's been so much competition and so much money's been raised, the prices have gone up, and that's where they are right now.
Is there anything that has surprised you about any of the deals that you've seen or done or been a part of in this space?
I mean, if you asked me like 3 years ago, I'd tell you the multiples were surprising me, but now I'm just kind of numb to it. It's, the deals are the deals, and look, they're good businesses. I mean, this is a good business that can produce cash flow at the terms that the private equity funds want them to, produce cash flow. The health systems are still buying up practices. I just got off the phone with someone right now who, is buying a large primary care practice for their health system. And it's an amazing market. Let's put it that way. I mean, there was the PPM market, 20 years ago, and now there's this market. And, I probably would have said to you, yes, 3 years ago, 4 years ago, 5 years ago, some of these deals would surprise me, but now, there's just so many people who are jumping in with it that, this is the way it is. This is the world we live in 2020.
Yeah. Are there any good resources out there for anybody who wants to either learn more or understand how to position themselves to be able to get the best multiple they can for a deal that they're considering for their own practice?
I mean, I hate, without making a self-fulfilling plug here, I think it's, definitely talk to somebody. Because, as much as you can read in a book or a trade journal or, some sort of survey, there's so much uniqueness to a particular practice that if you don't have someone who's been a part of, dozens of deals in the past, it's very, very difficult to draw the comparisons between your practice and this one that you're reading about in, ModMed that says that they traded for 12x EBITDA or something, so yeah, I really think you need to get someone who, studies practices, analyzes practices, understands both the financial and the operational impacts of them, and, understand why those are either direct or not direct comparisons to what your business is.
Yeah. Just like anything that's super technical and involved, I guess, that makes perfect sense.
It's worth the minimal investment to just get someone to take a look at it. I promise you.
Absolutely. Well, Stuart, Daniel, it's been a pleasure speaking with you guys today. Thank you for joining us on this episode of APM Success. If you liked what you heard this week, head on over to apmsuccess.com, where you can find more content and free resources to help you build a successful career in anesthesia and pain management. If you wanted to leave a review in iTunes, I'd also really appreciate it. Thanks for using some of your valuable time to join me today on APM Success.